So interest rates are about to come down. What does that mean for us? Well, I can tell you, most people think that interest rates coming down is a good thing, but there's a lot of people I've been seeing on X and on Facebook and Instagram and different places that say, "Oh my gosh, interest rates are coming down. That's going to crash the stock market." Well, in this video, I'm going to tell you why it isn't the critical component and why it probably won't crash the stock market. Here we go. So the stock market is at all-time highs, just right around all-time highs right now, pushing 41,000 on the Dow. And everybody's like, "Oh my God, it's a bubble. It's going to crash," especially because the Fed is lowering interest rates. Well, sometimes in the past, they use these charts to say when the Fed lowers interest rates, that that is bearish for the market. In other words, that's going to push the market down. Well, a lot of times the reason they're lowering interest rates is because there's a recession going on. That means there's a slowdown in consumer buying, there's a slowdown in housing, there's a slowdown in building, and all of those things create a negative effect on the stock market and in assets in general. And a couple of things are going on right now in the markets. Like, so we see real estate faltering a little bit up at its all-time highs here. I mean, you heard over the last couple of years that housing has gone up like crazy. But on the commercial side, we're seeing a bit of a faltering, right? We've moved to working from home a lot. We've moved out of the cities. There's some badly run cities that, some of these skyscrapers are trading for 10 or 20 cents on the dollar. So there's a huge deflationary effect going on in the market. Real estate is kind of at an all-time high and it's faltering. Certain sectors are faltering. Certain other sectors are not. So in Florida and Texas, there's a big boom ever since COVID to move to these more free states, right? And now that boom is kind of slowing down a bit. Why? Well, the main reason is because when you raise interest rates, people can't borrow at the same ease that they used to borrow. If you could get a mortgage at 3% before, and now the mortgage is 7 or 8%, you're not going to be able to afford as much house. So therefore, the people that are stuck in their houses are going to stay in those houses because they got a 3% mortgage. And the people that are new that would be buying a house would be spending a 7% or 8% mortgage. So the cost of money has gone up. That means the velocity of the actual trade in real estate has gone down a bit. And you're seeing some discounting in Florida. You're seeing some discounting in Texas and the like. So that's creating kind of a deflationary effect, or at least a disinflationary effect. You know the difference, right? Deflation means the prices are actually coming down, and disinflation means they're not going up as much as they were maybe a couple of years ago when we had inflation at officially at 9.1% for that 1 month. Now, the Fed, Jerome Powell, who's the Fed chairman, has a mandate, or he has a fake mandate. This is what they say the mandate is, but you can hear my conspiracy thoughts going on in there. Keep unemployment low, right? In other words, keep people employed and keep interest rates low. They say they shoot for 2%. Well, I could tell you, I did a video a couple of months ago about how we're really paying 11.1% on average over the last 4 years on just the things that we buy. So I don't really care what the Fed says or what CPI is, but we'll use their numbers for this video. Okay, cool. We know that they're fake numbers, but we'll use their numbers for this video. So let's start with the unemployment rate. The chart you see on your screen is showing how the unemployment rate now is ticking up a little bit. So the Fed is like, "Oh, we don't like to see people unemployed." That's what they say. They don't really care, frankly, but they don't want to see people unemployed. So they want to lower that number back down. Now, they're probably a little late in that number. That number has been ticking up for a little while here. And then the second one is this other chart that I'm putting on the screen here for you. And that is the CPI. Now, the CPI is the Consumer Price Index. They use a basket of goods that they say we buy, but the problem is they jimmy with it, right? And so they're saying that inflation is only 2.9 or 3.2% now. And what they're doing is they're failing to look at all of the increases we've had since, in this chart, 2021. And so we've had huge increases. I don't know about you, but I'm still paying, a lot more money for a hamburger than I paid 4 years ago. So just because they say that inflation is now manageable doesn't mean that prices are coming down. That would be deflation. We're not getting that. And that's probably okay for the markets. So looking at consumer prices, you're saying consumer prices go up. Now, I don't know about you, but my eggs didn't go up 3%, right? My eggs are up 80% in the last 4 years. I don't know about you, my filet mignon is not back down to where it was 4 years ago. It's actually 50% higher. Housing, rental prices, all these things are inflationary. And so let me get back to what the market's going to do. In general, there's a saying called don't fight the Fed. When the Fed is lowering interest rates, what that means is they're flooding the markets with money. If you got a bunch of extra money in your pocket, what are you going to do with it? Well, most people are going to go buy stuff, right? So you're going to go buy a house. That's why we had this huge amount of buying in 2020. That's why we had these huge bubbles in Florida and Texas and just home real estate around the world. And so that's because there was free money flooding the markets. Well, if there's not free money, like in the last couple of years, that money's been contracting a little bit. And so prices haven't been going up as much. And the same thing is true with the stock market. When people flood the market, we've had these incredible record increases in the stock market because people are like, hey, I got this extra money in my pocket. What am I going to do with it? So they put money in the market and they would make money on these huge stocks, like Nvidia that go up like crazy 10 times. And they'd be rich. They'd have even more money. And that would mean they would go buy a house, even at the higher price, keep pushing those prices up. Well, when the Fed starts to lower rates, what does that do? Well, it allows more people to start selling their houses because other people can buy them, and the velocity of money starts to accumulate again. And when people start to move money around, velocity of money, lots of transactions going on, that is accretive to the markets. It's good for assets. It's good for stocks. It's good for gold. It's good for Bitcoin. It's good for real estate. So what you're seeing is a whole bunch of macroeconomic trends that are going to be pushing assets up. It doesn't mean we're going to have some, all perfect days and we're not going to have some really bad days. We are. Things are in a rolling bubble right now. Real estate is in a rolling bubble. The stock market, certain sectors are in a rolling bubble. You'll see a year ago, the NASDAQ stocks were down. And then over the last 6-8 months, they've been up. And now they're kind of faltering a little bit and something else will take over. These are rolling sectors in all of the different assets. But overall, what I believe you're going to see over the next 2 to 4 years is an asset inflation. This is why they say in these economies, the rich get richer because the rich people or people with a few bucks in their pocket can buy assets. That makes them even richer. The people that are just struggling to pay their bills, they can't put money into assets. They're just struggling to pay their bills and maybe even going into debt. So they don't have a lot of extra discretionary income to invest in assets. So I want to debunk that myth that because the Fed is lowering rates, that's going to lead to a crash in the asset markets. I don't believe that's the case. Now, a recession may lead to a crash in the asset markets, and that is what Jerome Powell at the Fed and the Fed are trying to avoid happening. Make sense? So do your own homework. Be careful what people tell you because they're going to just try to scare you. Why? Because that gets them eyeballs, right? It gets them more ad revenue. Do your own homework. Look at charts like this that come from the US labor statistics, question them, have your own opinion, and recognize that you are the smartest person in charge of your money. And you get to decide if what I'm saying is true or what some other pundit on the internet is saying is true. Good luck to you, and I'll see you on the next video. Take care.